Okay, everyone. Yeah, thank you for attending our first real estate seminar by Real Estate, I guess, Tax Saving Strategy by Zhou Agency. And I want to give everyone a little bit of a background why we're doing this. We're doing a 10 webinar series. The content is gonna go from this basic to more advanced, basically talking about why real estate investment is really the best investment under the current tax code. Is more from the tax strategy. Yeah. So first of all, I would like to introduce my co-host today, Brenda. Brenda is a client still, right, Brenda?
Yes.
Yeah. Okay. And she has an amazing real estate journey. I think everyone knows me, so I'm not going to talk too much about me. Brenda, can I give us a little snapshot?
Well, nice to virtually meet everyone and nice to be here, Justine. Thanks so much for asking me to be here. So I historically, by profession, have been a social worker and an educator, and started investing in real estate on the side. My husband and I, 2006 was our first purchase, and we did we built a spec house actually. So we kind of dove in with both feet, got a good deal on a lot, and built a spec house and sold it, and then kind of sat back and watched while the market went up and went crazy on the West Coast, especially where we live, from 2006 to 2008. And then it crashed, obviously. And so then we kind of sat back and watched some prices fall everywhere, and decided to buy some real estate on sale. And so started investing in long-term rentals. Like the end of 2009, I think, was our first purchase. Got in on some short sales and foreclosures and got some good deals, and just initially was kind of a long-term retirement plan for us. But I liked it. And so was kind of on the side, still kind of turning over our money and buying and selling and reinvesting. And so always kind of with the idea, I'd read a book by Robert Allen called Creating Wealth, and it basically said that if you buy 2 properties every year, at the end of 10 years, you could be work optional. And so I guess I was kind of doing that. And so in the back of my
head, you achieved that, Brenda.
Yes. Yes. So I was doing that. And so, yes, in 2020, when 2020 hit, all of my contract teaching and training work and social work, kind of came to an end. But the good news was, everyone was like, oh my gosh, what are you going to do? And it's like, well, I'm just going to start taking a salary for myself for my real estate, because I'm making way more from my real estate than I ever did from teaching or social work. So been kind of full-time into real estate investing since 2020, and playing chess with my properties and turning over my money faster.
I love the metaphor.
Mm-hmm. Yes, making my money work for me, and Justine has been helping me play chess.
No, I'm just brainstorming with you. I'm here for you to bounce ideas with. I really don't think I've taught you anything. Brenda is definitely a great lifelong learner, that I would say. And you're also a great teacher. So I learned a lot from you too. So guys, did you hear that? 14 years, Brenda achieved the financial, is that how you say financial freedom, right?
Financial freedom, yeah.
Your job doesn't matter anymore, right? And for the few years I've known Brenda, she is selling and buying every single year, and all kinds of assets, right? Passive one, active one. That's why I invited Brenda. I think she really embodies, a good real estate investor who really utilizes all the tax strategies instead of going in blindly, not knowing what's going on. So kudos to you.
Thank you.
And thank you for taking time from your busy schedule. All right. Then I want to talk a little bit about my company, right? My elevator speech, right, Brenda? So we don't just do accounting. That's why people will say, why are you talking about real estate? So our core competence really is to provide tax efficient strategies and sometimes even execute them for you. That's why we have all these different arms The real estate is definitely one of the arm, and also that is why we're doing this webinar because we have a arm of very experienced real estate investment consultants on my team, and you will get to talk to them if you're interested at the end of this webinar. All right, let's go to the meat of the presentation. Why real estate investment? So I've been an accountant for 30 years, and I always say in my book of business who trade stocks, maybe 99% of them lose money. There's 1% making money. And you heard all the stories about that 1% person, right? You never hear from those 99% of people because it's really hard. I don't know whether anyone has watched The Dumb Money. The hedge funds are making money from us dumb people playing stocks. I didn't know that that's the phrases in their industry. It's very correct, okay? But most of my real estate investors make money. I mean, they are very smart and hardworking, but the chances you make money is much better in the real estate. And this is a couple slides just say real estate is a good investment. It's a good investment when you have high inflation, which is what we're having right now. So these are just the statistics. But there is a fundamental reason why real estate investment is better, is the tax strategies. So it's not just like, oh, why? I think is the government wants you to invest in real estate long term because you know what? Is it true, Brenda? Real estate is the engine of the economy.
Absolutely. I mean, we saw that obviously the real estate market led to the crash, in 2007, 2008. Housing is everything, right? People need a place to live, and they're always going to need a place to live.
Yeah. So today I'm going to share three. So this is the first seminar in the whole series is the basic tax codes to help real estate investors like Brenda to have great cash flow and not pay tax, all legally on the table. All right. The first tax code I want to discuss is depreciation. And so this is, I said, it's basic concept, right? People would say, hey, you just said property appreciates. What's depreciation? What are you talking about? You're contradicting yourself, right? So depreciation is basically a tax code. It's saying if you have an asset that, let's say you have a property that you rent out. I think I have a very simple example to showcase how depreciation works, right? In our jargon, we say depreciation creates phantom expenses to deduct your rental income because it's not a real expense, but it's on your tax return as an expense. So you can get positive cash flow and not pay tax, which happens to Brenda every single year, right?
Yes.
Yes, and that's really sweet, right? Where else can you make money and not pay tax legally? The joke is even selling drug money, you have to pay tax, right? That's how they got out of home. Okay, so here's the very simple scenario. I'm in Chicago right now. I'm looking at some beautiful condos right in front of me. So condo cost of one bedroom is probably $300,000. I would say the land worth very little in Chicago, especially if it's a condo. The percentage is really low. Let's say 25,000, and there's 275,000 is the structure. And IRS basically said that's their code. Every rental real estate is depreciated at 27.5 years. It doesn't matter when you buy it. I mean, it only matters when you buy it. It doesn't matter when it was built. So you can buy a condo that's been around for 50 years. You start the depreciation again, right? So every year you can grab a $10,000 expense on your tax return. And let's say if you have a net cash flow of 15,000, which is not a phantom number. So in Chicago, a 5% cap rate is very, very common. So with a $300,000 condo, if you pay cash, you're going to have $15,000 of the net cash flow, but you only need to pay tax on 5,000. I would like Brenda to give us some real life examples, maybe one of your properties or your experiences on how depreciation has helped you to accumulate your income without paying tax.
Yeah, I mean, depreciation's huge, right? Because like Justine said, it's a paper loss. And so on your taxes, just like what she showed, I mean, any property that you purchase, for example, a year and a half ago now, we purchased a property, a single family home in Arizona, for 400,000. And so, 27 and a half, basically the numbers are, a little better than this one. We're looking at what, 12,000-ish dollars a year that we're able to take as just a straight loss on that. So for that property, we cash flow about $600 a month net cash flow at the end of the day, so $7,200 a year. But the loss is like 12,000. So basically it's a negative number. So we're making net cash flow of $7,200 a year, but yet it's a loss of, close to 5,000 on our taxes. So we're actually getting money back from that property. So it's huge, right?
Yeah.
And so then
Brenda gave us a really good, Brenda gave us a really good example. I'm talking about you pay less tax, but Brenda says not only you don't have to pay tax, you even get refund. Because Brenda has a perfect marriage, right? She is a real estate professional and her husband is a W-2 earner. So this property she's talking about from Arizona is cash flowing what 7,200, and the depreciation was 12,000. So actually shows a loss on the tax return as 4,500. And that 4,500 is gonna go offset her husband's W-2 income, guys. That's huge, right? And then we have another thing we're going to talk about, even bigger than this, Brenda. Brenda knows bonus depreciation. That's what is that the buzzword of this whole decade, right?
Yeah.
Since 2017, the tax reform, the bonus depreciation. Everyone calls me, Justine, I want a bonus depreciation my property. Why? What is bonus depreciation? Brenda probably can give a better answer than me. You want to give us an example? I have a slide here to tell people. Basically, you accelerate the depreciation. So we just talk about the 27.5 years, right? To divided by 27.5 years. But if you do a cost segregation study on your property, and that property will be able to grab more depreciation in the beginning, or in the first, in the beginning, especially the first year you put in service, because the tax code basically said any property that's less than 15-year depreciable years can be 100% bonus depreciated, basically expensed in a way, up until the end of last year. This year is 80% bonus depreciation. So this tax reform actually made depreciation even a bigger buzzword and a bigger strategy. So here is another my example, but I'm sure Brenda's example is going to be much beautiful than mine. Mine is very dry textbook one. So the one that we just talked about was taxable rental income is 5,000, but if we do bonus depreciation, we can accelerate the depreciation to put everything that's under 15 year to take it 100% off in 2022. So you will have a bigger depreciation, and now you really are going to have. I think the math is wrong here. I'm so sorry. Your loss is gonna be actually 40,000, right, Brenda? I think my basic math is wrong here. It's not 4,000, guys. It's actually
just lost to zero.
Yeah, it should be called rental loss, $40,000. And if this is Brenda in her perfect marriage, if her husband made 100,000, they only have to pay tax on 60,000 now, right? I'm sure, Brenda, you have a better example to share with the crowd on bonus depreciation.
Yeah, so bonus depreciation. So like Justine said, as of through last year, so through 2022, you can take up to 100%. So when she says anything that has a 15-year life or under, so that basically means most of the fixtures in the property, right? So flooring, lighting, landscaping, some of your appliances. So anything like that, fences, you can basically take 100% depreciation, you can accelerate it. And so instead of dividing it over the 27.5 years, you're taking it all in 1 year. So that 55,000 that she has listed on here is basically the total of, what you would add up to say that what are the appliances worth, what's the flooring worth, what's the light fixtures worth, any of those types of things that are in the home. And so this year, like she said, it's 80%. I believe next year it goes down to 60, and then it phases out in 2025. Is that right, Justine?
I think it's 2026 is the last year. My math is so bad. I even made such a big mistake. Okay. You should not count on me. But guess what? We have calculator. We have calculator.
Yeah. So it eventually phases out either in 2025 or 2026. And so like this offers a great opportunity, like she said. So for example, that Arizona home that I mentioned, we are doing, accelerated depreciation on that property. Because for us, in our example, with me being a real estate professional and my husband being a W-2 employee, even if we don't need that loss on our taxes that year. So this is when you look at, for example, the normal depreciation, say that, $4,000, $4,500 loss that we have on that property per year, then that's per property, right? So if you own 10 properties and you have a $4,500 loss on average per property, now you're talking a $45,000 loss, right? That offsets. So if my husband is a $100,000 W-2 earner and we have 10 properties where we have losses of $4,500 per property, so $45,000, and then we have one property that we do accelerated depreciation on, like this example, and we have a $55,000 or 40,000, 55,000, whatever loss, we could essentially basically wipe out his entire W-2 income by adding all those losses together with me being a real estate professional. I believe Justine will talk about, if you're not, I think it might be up to $25,000 a year losses that you can take, but I'll defer to the professional in regards to that. But you can carry these losses forward as well.
So yes, these losses are always gonna be in the corner to help you in the future. Yes. Okay, did you guys hear that? Brenda is able to bring her AGI down to 0 while enjoying a lot of cash flow. Is that something? I think it's magical. And again, so tax codes, my joke used to be the tax codes are written by real estate investors. That's a joke. The real thing is the government write tax codes intentionally to motivate you to invest in long-term real estate. It's good for the economy. And Brenda, I have some good news to share with you. I'm doing a lot of continuing education right now as a CPA. This is the continuation month, continue education month, right? They said they might revive bonus depreciation after 2026. I know, you're so happy.
Yes, that's huge.
Yeah,
well, and
we have a lot of my physician clients that jump into this real estate investment in the last 5 to 7 years after the 2017 tax reform. Physicians make a lot of money and they pay a lot of tax, right? We're talking about some of them, the marginal tax rate is 50%. And if they can do real estate and if they can do short-term rental, they don't even have to become a real estate professional. We're going to discuss all those things in the later episodes of our series. But this is huge bonus depreciation. We should, take advantage of it, right?
Yeah, and one more thing, just in regards to that too, is Justine has seen, we've invested in the last few years in some syndications, which is essentially real estate crowdfunding, right, where you can people can pool their money to buy a lot larger property or development, commercial development, residential development. There's all different kinds of syndications. But if it's a real estate syndication, even mobile home parks, storage units, things like that, they can also take advantage of accelerated depreciation. And, sometimes you can end up depreciating more than the investment that you put into it. So, if you invest 100,000, because they're taking advantage of this accelerated depreciation and losses too on some of these developments. And so sometimes that can offset the total amount that you've invested on the losses with some of these syndications. So that can be huge as well.
Yeah. So what Brenda talked about, the passive investment, basically you are just going with a bunch of your friends, kind of, right? You don't know them, but you guys co-own this. You are a limited partner of it. And if they take accelerated depreciation, it benefits you too, right? So depreciation is really your friend, and the properties should not depreciate itself, right? So this is a once for all. People say, see property depreciate, and even tax code says that. No, it's really a phantom expense. Okay, so here I want to tell everyone a small anecdote, right? How brilliant Brenda is. We have a mutual friend. They also are very good real estate investor. They have beautiful cash flow, but not much income to show on the AGI line on the 1040, right? So she called me last year saying, should I do cost segregation and accelerate depreciation? And you say, you're doing fine. You don't need it. You don't have anything to write off. You're already doing great. This is an extra thing. Just take your regular depreciation, come from a professional. But Brenda and her, I think, had dinner, right? We just realized, how as real estate investors, a lot of them actually invest in hard money lending, right? So she happened to have a lot of interest income. So the depreciation that helps you not only offset your W-2 income, it also offset interest income. Just somehow in my head, it didn't connect the two dots. But guess what? Our friend didn't listen to me, listen to Brenda. So that's why I'm telling you, like, tax is so complicated. It's you move one piece, everything moves. So as a real estate person, you can actually decide how much check you want to write to IRS. Isn't that beautiful? Because you can do the cost segregation study later before you file the tax return, right? That's why I'm glad we had these conversations. And you need to have a lot of conversations with your accountants. And it's never like I give you a list of strategies, you just do it, right? Your situation changed. That's why me and Brenda always have continuous conversations about a lot of things. The next topic is the next tax code, why real estate is good. It's the 1031 like-kind exchange. Actually, when I first met Brenda, she was doing a 1031 like-kind exchange, right? Yeah.
Yes.
So yeah, and I will let her share the story with you guys. It's like a TV show, I think, right?
Oh my gosh.
So
Yes.
what is a 1031 like-kind exchange? So basically, as a real estate investor for rental real estate, you can sell. So we just talked about how you can get cash flow without paying any tax. Now, after 10 years, if you gotta sell it, hey, there's no free lunch, right? Now it's gonna pay tax. You have to do depreciation recapture. Like, Justine, are you kidding me? You just said it's good. Now I'm selling it. I have to pay all the tax. You don't have to if you plan it well. You can do a 1031 exchange, basically exchange to a bigger property or exchange to multiple properties from the proceeds of selling this property. And you don't have to pay any tax if you manage it well. There are a lot of very strict conditions that you're going to meet. I'm not going to bore you guys, right? I'm a tax nerd, but not everyone. So I don't want to be telling you what the tax codes are. But I'm telling you, this is definitely, if you want to be a real estate investor, that's what you do. Don't say, oh, I just pay a little bit tax. Every tax you pay erodes into your profit, right, Brenda?
Yes.
Yeah.
Hugely.
Uncle Sam's dirty hand. Yeah. So you want to tell us a little bit about your 1031 exchange experience?
Yes. So again, this is like playing chess, right? And so, like Justine said, I mean, the whole idea is, if you do a 1031 exchange and you want to reinvest into a larger property, it's essentially like playing Monopoly, right? I'm playing Monopoly and I hated that game as a kid, so it's kind of ironic that that's what I'm doing. But ideally you sell things and you buy more, right? So you buy one property, it appreciates, then you cash out the cash in it, you're able to buy two properties, or maybe you've made enough money, you're able to buy up to 4 properties. And so you're constantly leveraging your money and making your money work for you, right? And so as long as, like Justine said, you reinvest all the proceeds from the sale, and there's a few other stipulations, but that's the basic idea, then you don't have to pay tax on it. And the idea is you keep doing this until like you die into perpetuity, right? So there are some timelines associated with the 1031 exchange. So there's 45 days and 90 days and 180 days.
Those timing sucks, right?
The timing when it's a really hot real estate market, which essentially is what we've been in for years now, right? Can make it very challenging to identify properties within 45 days. I mean, especially if you're considering that you have to do inspections on these properties and everything else. And so I always tell people, if you're planning on doing a 1031, have a plan A, a plan B, and a plan C. And luckily, you can have up to 3 properties that you can identify as replacement properties, is what they call them, right? So in theory, you should start looking, maybe before even you put a property up for sale. So if you're doing really good planning ahead of time, you might want to look at your portfolio as you're building your portfolio, so you don't only want to look at return on investment, but you want to look at return on equity, right? So what properties have you seen a lot of value growth, right? So maybe you bought it for 200,000, now it's worth 400,000. You've paid down the mortgage 60,000. So you have $260,000 sitting in that property. Well, if you only have to put 25% down, now you can buy $1 million property if you cash out that 260,000 and use it to put down on something else. And so if you're planning on doing that, so take a look at your portfolio every year. Consulting with your CPA, with Justine, who's very knowledgeable, and thinking about, okay, which property do I maybe have a lot of equity sitting in that my money is not working as hard? as it was originally, that my return on equity or return on investments essentially gone down when I look at how much money I've seen this property that I might want to sell. And so if you identify that property, then all right, if I'm going to do a 1031 exchange, then you can kind of get ahead of the game and start potentially identifying replacement properties places, and depending on how the market is, then you can try and time it for when you sell to give yourself the maximum amount of time to identify. So for me, I tried to do this. And I mean, anyone who's bought and sold property knows that things happen, right? Things can happen.
I know you are a good planner. You're such a good planner. Things still happen.
Things still happen. So, I was trying to get some new construction property. I had a property that was supposedly 95% of the way done that I put an offer on, that the city in Cleveland, to name a city, that held it up. There was a gas issue. It was some public utility thing that the public utility company was taking months and months and months during the pandemic to fix this. And they couldn't pass final inspection, even though the thing was 95% done. So we had to ditch that option, go to another option. We had 2 new construction properties as another option. And one of them, turns out, they had been telling me was almost done, and they hadn't even broken ground on it. So that was a whole nother interesting story. Like Justine said, for a TV show, like when someone's trying to sell you swampland in Florida or a house in Florida that doesn't exist. And so anyway, so we were on option C, of a duplex in Houston. And because of the ice storm in Houston that year, that, the contractors were slammed, the construction industry was slammed, and the duplex, which, timeline wise, we'd been months ahead of things, that it would be done, it would be closed within the 180 days that we had to close. Suddenly, we closed on the very last day, and I was calling Justine in a panic, like, what's going to happen if we don't close?
You were crying.
I was literally on the phone with her. She couldn't see me. I was standing at the bar in my kitchen, and I had the phone sitting on the bar on speakerphone. And when she told me how much the potential tax was going to be if I had to pay the tax and not do the 1031 exchange, I literally doubled over and was taking deep breaths, like doing a yoga pose. When she told me it was going to be almost $40,000 if the 1031 exchange didn't go through. Thank God the contractors pulled off a miracle, and we closed on the very last day that we could, and it went through.
I think really the moral of the story is you really need to plan ahead a lot. Did you guys hear Brenda said, before you even sell, you have to think about buy, and you have to look at your portfolio all the time, which one you should 1031 exchange. I think a lot of my clients always feel 1031 is so much hassle. I mean, it is hassle, but if you plan it well, it's not going to be that much hassle. And then even that, you might fall. So like Brenda said, you have to have option 1, 2, 3, A, B, C, right? To get it through. But Brenda pulled it through because you have tenacity. Because she said, yes, I'm not paying tax.
I'm not paying $40,000 in taxes. This is going to happen. So yes, luckily the contractors helped move heaven and earth. Justine helped. It takes a team. And on the very last day possible, we closed and we did it.
Yes, very good. So I always tell people, talk to your accountant before you do anything, instead of after you do everything and talk to your accountant. Like Brenda could have just called me a text. Oh, that 1031 failed. How much tax I have to pay? That'll be too late. Right? Yeah. So that's the moral of the story. So here I just want to mention again, the concept is very simple. You can exchange to any type of property anywhere in the US. I believe you can even do a little bit overseas, but just not to touch that. It's very, very restricted. So mainly in the US, any property from 1 to multiple, multiple to 1, as long as you put all the money, the proceeds into the next property and borrow at least the same amount. But why would you not borrow more, right? You should borrow more. Like Brenda said, this way your portfolio will get bigger because of the 1031. So the last one. The last law strategy, the tax code, right? Oh, I'm sorry, I forgot this one. Thank you, Christy, for doing that. I forgot that one. So I guess you guys get it. Otherwise, you will have to pay so much tax, right? Okay, the capital gain and depreciation recapture, that's a lot of tax to pay on 300,000. But you do a 1031, you pay nothing. So the last tax code that can help us is people say, yeah, but it's only deferring, right? 1031 does not eliminate. You're right. It doesn't eliminate it. Just only defer to the time that I go. There is a step up basis in the tax code too. So I think Christy prepared a really good one. So I think there's yeah. So if I started with $10,000 to invest, is I'm as smart as Brenda, right? In 50 years of my life, I'm going to have a portfolio of 10 million. Is that possible, Brenda?
Yes.
Thank you. You probably don't even need a
Yes.
50 year. You don't need a 50 year. I need a 50 year. And I get to 10 million. The day I leave this world, my kid's going to inherit my properties with this step up basis, which is the current market value of my portfolio. So no capital gain tax ever. So that helped real estate investors to eliminate all capital gain tax. Does that mean there's no tax to be paid? That's a question mark, because there's another animal there called estate tax. But that's a different story. You can always put your property into irrevocable trust to avoid that. So tax codes are just difficult. When you say tax, there are different types of tax, right? I don't know what your plan on. You're gonna just let it roll, right, Brenda? I don't think you wanna ever pay tax. At the end, I think you might
No.
charitable
Yeah,
donations.
and yes, yeah. So I'm gonna look into maybe like, living trust type things with donations for nonprofits. Like, kind
Mhm.
of been discussing that already with some nonprofits that I really like of options. Because the problem is you spend a whole bunch of time focusing on building up your portfolio, and then suddenly it's like, oh my gosh, like then it becomes challenging if you're going to downsize your portfolio. And so thinking about the best way to do that, like Justine said. And so, yes, obviously leaving it to family members, charities that you care about, you can leave it to charities even while you're still alive, or after you die. So there's different options in regards to that then can help avoid taxes entirely, and even avoid taxes on any of your income, your net income that you're receiving
Yes,
too.
yes. There are a lot of strategies to go as a real estate investor. So you make sure you actually never pay tax, and it's not just never pay tax. Also get refund from your W-2 income. That's huge, right, Brenda? And the money Brenda
Yeah.
gets, she didn't just go buy a Gucci bag. She invests in real estate. That's why she's growing so fast, right?
Yes. Yeah, I mean, for me, it's about like, really reinvesting. I mean, I think it's a switch in mindset, right? Because I think especially if you grow up middle class, it's like, work hard, save your money, work hard, save your money. And absolutely, you need to work hard, but you need to make your money work as hard or harder. And so ultimately I keep thinking about how can I make my money work as hard, if not harder than I do. And so playing the tax game, like there's so many different ways that you make money from real estate, right? It's not just your cash flow, it's not just your equity build, it's not just your appreciation, but also from your tax savings. And so for us, so I mean, for example, I live in Oregon, our state income tax is almost 10%. So basically we're in a 35% combined tax bracket annually. So to take a round number, if my husband's making $100,000 a year, that means we're paying 35%, $35,000 of our income to the government every year. But if we're able to offset that, and so essentially look like we're making no money, then that's a $35,000 gift, on top of that in our pocket every year. So that also adds to your income. So we have to include that in our real estate income as well, right? So that's essentially
Yes.
another $3,000 a month in tax savings that we're getting back in our pocket.
Yeah, that's why I said you had a perfect marriage to do that. Very, very good. So in a summary, I guess, because of those three tax codes, depreciation, like an exchange and step up basis, as a good real estate investor, tax savvy real estate investor like Brenda, you never pay tax and it's achievable. And because you never pay tax, guess what? You keep much more what you make. And that's what really matters, not how much you make, it's how much you keep in your pocket. So I guess that's the moral of the story. We only a little bit over the time, Brenda. We did well.
Yes.
Okay. So, I mean, we're gonna do a lot of Q&A. So, I'm sorry, Christy, I didn't ask anyone to write Q. You can write a lot of questions in the Q&A, and Christy will bring it up to the screen. We don't want this to be a boring me and Brenda telling stories. We want this to be interactive. But on this slide, you can see is if you have any, everyone knows me. You guys are my clients. So just email me with questions. And we also have a real estate investment consultant on the team. His name is Sushil. I believe he is also listening to the webinar, but you guys can actually schedule a 30-minute real estate consultation with him. So my team does a lot of Chicago real estate, but they also give you a lot of consultations on the passive investment that Brenda talked about, and just the whole real estate investment strategy from a tax perspective. So they are really good. I'm very proud of my team. So if you can schedule a call with Sushil has more than 10 years of experience in the real estate industry. We'll give you some guidance. And what else? Oh, this is just our blur. Let's do Q&A. Christy, I'm gonna wait for you to put the questions up on the top.
Well, I've already posted a few. Well, I guess I'll just do one by one then.
Okay. Sorry, this is your, I don't say sorry. The house, are you living in it or are you not living in it? If it's your primary residence, you cannot do depreciation because it's not a business property. You don't generate income unless you Airbnb partial your house to guests, then you can. So always remember, you can take depreciation if the asset is for business use, is generating income. If not, you cannot take the depreciation. And as long as it's a depreciable asset, you can always take bonus depreciation if you want to. It may not help you this year. It should help you in the future. Right, Brenda, you have anything to add?
Yes. Yep. Ditto, ditto.
I hope this helped you, Fanaz. I hope I say your name correct. I will let Brenda take this one first, and I will add on my opinion. Good question.
Yeah, that is a good question. And so you do have to think about it like if you're going to sell the property, and especially if you don't 1031 exchange it, right? If you 1031 exchange it, then you can avoid this. But if you're going to sell the property, then you always pay depreciation recapture tax, which is higher than your passive, capital gains tax. And so usually it's at whatever tax bracket you're at because it's considered like active income. I think, correct me if I'm wrong, Justine. But so that is something that you have to think about is if you're going to sell the property, then keep in mind that you will have to pay depreciation recapture tax on whatever the depreciation that you've taken. And so that can then give you more incentive.
If we don't 1031, if they 1031, they still got the benefit, right?
Right. So yeah, that's the more incentive to do a 1031. Right.
No, you are a real estate investor, you just gotta do 1031. It's not if, it's how. Right? Agreed, Brenda? Yeah.
Yes.
But
yeah,
that's Go ahead, Brenda.
Yeah. I mean, you just like always crunch your numbers, right? And look at the numbers. I mean, sometimes you might want that money for something else. And so, but, crunch the numbers ahead of time so that so it's not a surprise. If it's a property, that you haven't owned as long, if you haven't taken as much depreciation, if you haven't done accelerated depreciation, then the hit might not be as big, right? And so just numbers never lie, and you have to look at your individual situation. But ideally, we want to keep our money working for us, reinvest. And so keep doing 1031 so that you don't have to pay that depreciation recapture tax.
Yeah, so I'm going to add a little bit on Brenda. So very interesting. This morning, this is my tax planning season. So I do 7 or 8 a day talking to people about their 2023 tax. That's why I say we don't just do tax returns for you. We do a lot of planning. And that's actually the best part of my job. I love it. I get to know my people better and I can give them better advice because during tax season, all we worried is this correct? How much I have to pay, right? That's like so narrow focused. But now we're talking about, so this morning I talked to, I believe he's a physician. I'm not going to say his name if you're listening. So I actually tell him not to do bonus depreciation after I heard his situation. I can explain to you why. So he has a short-term rental, which is not cash flowing very well. So it's a negative, even take regular depreciation. And he is not self-managing it. He has a property manager. He has very high W-2 income, okay? There is no way he's going to take any deduction, even the 25,000, Brenda, because his income is way over the sky, okay? So he asked me whether he should do a cost segregation and take a bonus depreciation. You can. Nobody will tell you no. So you're going to have a huge loss. He has a smaller loss every year carry forward. If you take a huge loss, it's not going to help you in any way in your tax. Yes, it will help you accumulate the passive loss, but he does not want to do any other investment right now, nothing really to offset that. So, I mean, you still have to pay for the cost segregation, right? And you have to pay me to do the depreciation schedule for you. I'm not saying that's a lot of money, but it's really not giving you anything. Unless you have some other plans to utilize those passive losses. I'm sure he works really hard. He has little kids, so he doesn't have time to do all these things right now. So in his case, bonus depreciation is not going to hurt him, but it's not going to help him either. So to answer your question, it's never going to hurt you by doing bonus depreciation, but it's just sometimes it doesn't help you. If it doesn't help you, why'd you do something that's not going to help you? It takes you time. Everyone's time is priceless, right? Okay, I hope this helps you. Guest 470. Christy, next one. Okay. Hey, Boone, how are you? I know you're becoming a real estate professional this year. Boone is my client. Is the cost segregation worthwhile for single home? I heard it is about $5,000 to do it. I think Brenda and I are going to agree on this. Yes. Why is single family? It does not, I mean, sure, if the property is only worth 50,000, maybe not, right? But, if it's, I think your property is going to worth a little bit more than 50,000. And then make sure, Boone, you're taking the real estate professional status this year, track all your hours. Then it can help you to offset your big W-2 income from your wife. So you guys will make a perfect couple again. Yeah. You have anything to say, Brenda, on this question? Oh, I'm sorry.
So general, yeah.
Go
so
back.
like kind of
Go ahead.
General, I don't know, just rule of thumb that I've been told by the cost segregation people that I work with. So I'll say I'm currently working with Cost Segregation Authority. There's a whole bunch of different places that do cost segs for them. I believe it's around $3,500 to do a cost segregation for a residential property. And they kind of say general rule of thumb is like if it's under $400,000, it might not be worth it. And so just kind of look at that. If it's over 400,000, it might. You just have
yeah. Brenda has a good point. Yeah. Before this so people always think cost segregation is a new thing. It's not. It's been forever there. And most of the cost seg was done on big commercial buildings before. Nobody does it on residential because it's just not gonna, it's a big tool, right? You spend money to do it. But because of the tax reform, because of the bonus depreciation, because of the real estate professional tax code, this has become a buzzword too. And in your case, Boone, you should do it. And as far as I know, the cheapest cost seg study is those, I think the website is called DIY cost seg, and you pay less than 1,000. So if it's a small home, you don't think you need an engineer to go into your home and do it. It's I think it's DIY cost seg. Or you can hire a professional firm. I believe, it's 3,500. I've seen 2,500. So negotiate and look at what's best for you. But Boone, you need to do it. Okay. Okay. Greg has a question. Are you able to write off passive loss against ordinary W-2 income? Okay, I'm gonna give you $1 million answer, Greg. It depends. He doesn't like it. So depending on your income. So when your income is over 100, your AGI is over 150,000, you cannot write off any losses. And it starts to phase out at 100,000. And the most you can take is 25,000. So if your AGI is less than 100,000, you can take loss the whole 25,000 up to 25,000. When your income is over 100,000, start to phase out all the way until you hit 150,000, then nothing. So most of my clients, unfortunately, belongs to the over 150,000. So you cannot. But Greg, you are my client. You can come talk to me. You can do other tax strategies to offset your passive loss. Guess what? You can generate passive income to offset passive loss, which you don't have to pay tax on. Very simple one. If Justine is opening up a restaurant, it's called Justine's Diner, you can be my 10% shareholder. You don't do anything. I do all the cooking and cleaning and waitressing, right? And I made good money the first year. I made $100,000 net, and 10,000 go to you, Greg. Guess what? That's passive income. So now you can get money in your pocket without pay tax to use that passive loss. So tax is a beautiful thing. I love it. And I love the way Brenda said it, chess. Yeah, it's a lot of pieces, Yeah. Mm-hmm. Oh, Mr. Guan, how are you? Oh, I'm so happy to see all the clients. Theoretically, you can. Brenda, you have an answer to this one? It's cool.
So since you won't be able to do the bonus depreciation on the bonus house again next year, so then I can't see the rest of the question. What is the bottom?
I guess he's saying your bonus depreciation the whole house this year offset your income. Next you buy another one. Next you buy another one. I think that's the question.
I mean, that's kind of, yeah. I mean, that's why you're playing chess, right? And so yes, like then you won't potentially have those losses the next time. And so yeah, that's why I'm turning my money over more to keep playing the game.
Yeah, I think in theory this is right, Mr. Guan, but technically you can't do it because when we say bonus depreciation, doesn't mean you can bonus depreciation the whole house. And I know you live in California. Unfortunately, land value is very high. So let me give you a really quick example. Of $1 million home, your structure probably is only 400,000. So, and when you do bonus depreciation, you can only do you can only take the bonus depreciation on depreciable assets that's less than 15 years. So very luckily, you may get $150,000. And for 2023, you only have 80% of that, right? So you do your math. So you can't, and I know your income is way more than 100,000. So there's no way in your case you can do that. But the concept itself is a correct way to think. You keep buying, and that's what a lot of my physician clients are doing is every year they buy one, every year they buy one. So during the 2018 to 2022, they already bought 5 or 6 houses, and later on they can change that to the long-term rental. And then they will become financially free. Financial freedom, right? Is how you call that. Yeah. Mr. Guan is taking the whole concept to the extreme, which is cool. It makes sense. Next one. Do we have more questions? Okay. Oh, Hank, how are you? Great. I'm so happy to see all the clients. We need to do this more. We do have a good, it's just, I think the one we normally recommend to client is just a national provider. But Brenda, do you have some good ones you can tell people?
I'm not sure if the one that I use, like, where they operate and where they don't, that they might be more West Coast. And so, yeah, I would just Google, like there's a lot of them, right? And so I would read reviews and, go from that.
Yeah. And another thing, Hank, so nowadays QI's fee is much lower than when I first entered the field. It used to be 5,000. Now it's like 1,000. And there's I think there's a lot of disruptors in the industry that they make things more streamlined. Used to be only attorneys do it or title company does it. Now everyone can do it. So I've seen them $1,000, really, really affordable. And if you want, Hank, you can send me a quick email and I can give you the one we know. It's just, I think it's called I am something. Just it's a national provider. Mm-hmm. Okay.
Yeah, she said $1,000 is really standard, $900 to $1,000. Obviously, all the large national title companies like First American do it as well.
Mm-hmm, mm-hmm. Yeah, it's nice to have these industry disruptors. They really bring the cost down, right? When I first see that DIY thing, I was like, "Is that possible?" My client did it and showed me the report. Looks legit, and you can even buy audit whatever thing. Like if you get audited, they will stamp your report. Okay. Do these tax write-offs also count towards 1099 independent contractors? I think, Natasha, what you mean is can we use that to write off your independent contractor's income? Yes, you can. because independent contractor is just like a W-2, it's an active income. But again, remember what I said about income threshold. If it's over 150, you cannot offset passive loss with active income unless you're doing short-term rental and self-manage. That will be one of our seminar, webinar, whatever topic you can tune in. Hey, Rafael. I will let Brenda talk this time. I think you have a mix, right?
Yeah. So, I mean, the most tax benefits is long-term rentals are considered passive, right? So your passive capital gains tax. And so if you own it for, kind of 1 year and a day is the rough guideline. If you own it over 1 year and a day, short-term rentals, you're going to be taxed more as active income. And so, but you do have, some direct type deductions that you can take. So they, one, like Justine said, there can be some benefits to short-term rentals, especially if you're not a real estate professional and you have a short-term rental, because then that active income and passive income can offset one another. So it's a strategy. So yeah, Justine, go.
I think you answered this question beautifully. I mean, people always laugh at me like, why you always say, oh, it depends. But it all depends, right? So in your case, Rafael, we talked about that because you have a job and your income is beautifully over that threshold. So it's not a bad problem to have, Rafael. So you need to do short-term rental and self-manage to be able to offset. Or we also talk about your wife can become a real estate professional. Then you can do both long-term, short-term. Doesn't matter. You'll be in the Brenda's world. Short-term, long-term doesn't matter to Brenda because she's a real estate professional. And we will have a webinar on real estate professional, guys. Okay. I think our time is almost up. Maybe another couple of questions.
Maybe, yeah. I think I'll just put this as the last one. We still have a few other questions, but I agree. I think we are running out of time, so we'll just treat this.
Yeah, two more questions. Okay, two more questions after this one. So, I personally do not like this strategy, Young. I do not know what you're trying to achieve. So you're selling your primary residence to the S corp so you can take a bigger or quicker depreciation. That is not true. So there's a lot of misconception that people think if my property is under a business name or in a structure of LLC or S corp, it will take bigger depreciation. No, it's the same thing. Whether you do it be under your name, your LLC's name, it takes the same depreciation, whatever method you want to take. And a lot of times real estate should be in LLC and not in S corp, because S corp normally should be an active business, and LLC is a good holding company. It really help you to limit your liability, not to really give you tax benefit. But that said, does LLC help you to write off a little bit more? Maybe, but that's not your main reason you do an LLC. So Yang, if you have more questions, you are my client. You can always send me an email. We will discuss. I love my discussions with clients. Everyone brings new perspective. Two more questions, Christy. I think we have to wrap up.
And so that one, Justine, just to add a little bit, like that might differ if you're doing flips, right? So if you're going to do flips.
Oh yeah, you're right. But if you're doing flips, you're right. S corp is good because it's active business. Thank you, Brenda. I need you. I said if you ever retire from a real estate professional, join my firm. So we are talking. So Brenda had a really good point. I talk about rental real estate should be under LLC. So I'm also correct, but I'm talking about rental real estate. A lot of real estate investors, Brenda mentioned that you can be flippers. If you're flippers, so you're not a real estate really investor, you're more like an active real estate operator, right? So the income you made on the whole trade is going to be just like a W-2 income. So S corp is a great idea. Mm-hmm. So the step-up basis, Irvin, has nothing to do with your estate limit. So the step-up, let's say that my $10,000, I was so smart, it actually become 100 million instead of 10 million. So I'm definitely over the estate limit, right? So I will have to pay estate tax if I don't do good estate planning. But I still don't pay any capital gain tax. There's no limit on the capital gain tax. I hope I answered that question. Do you think so, Brenda? Yeah. So no limit on the step up basis, But if your asset, if let's say when I go, my kids get $100 million building, they still have to pay estate tax unless I had put that into the irrevocable trust. Mm-hmm. And Owen, I know you really need to work on it because you are the fortunate few that need to worry about estate tax. It's a definitely good problem to have. Plan ahead. They said you should. No smart people, no tax smart people should pay estate tax. Owen, I'm gonna challenge you. Okay, last question of the day. Oh, that's a good one, Thomas. Why would you want to pause depreciation? If the property is no longer being rented, it's no longer in service, yes, you can pause it. But if it's in service, you should not pause it because the IRS will consider you actually took depreciation even if you didn't take it. That would be the biggest misstep. I think we're good. So I think I have one more last blow that Christy asked me to say is we actually going to make this 10 webinar series into blogs too. And you can sign up to read the blog or something. Where is it? I'm sorry, guys. I'm not good. I'm not a good. Yeah. Christy, you can say it. You can say it. You're better than me. Are you there, Christy?
Yeah. I just was hard for me to unmute my mic. So yeah, I mean, these are just like our various of social media channels, and I know everyone has their own preference of which one to follow, but we will start posting the series of real estate tax blogs onto our Facebook and LinkedIn and WeChat, and also our monthly webinar recorded video will be posted onto our YouTube as well. So just you guys can follow us on your preferred social media to get all of this good content and information. And that's it.
Okay. Last but not least, thank you so much, Brenda. I know you're very, very busy and you're helping your dad with his business, and you still come and really enjoyed all your beautiful comments and your story. I'm sure all my clients appreciate your time.
My pleasure. My pleasure. I love working with you, Justine. She's great. Talking strategy, that's a very, in my opinion, rare quality for a CPA. She's great at big picture strategy and at little picture minutia questions. So thank you, Justine. I appreciate you, and happy investing, everyone.
Yes. Thank you, guys, and bye-bye. See you next time.